Good morning, you fine people joining us here at the Flow Show. Hope you're all doing fine and dandy today. Good morning, Mr. K-Man. How are you doing, sir?
Good morning, Ryan. Good morning, everybody. Well, I'm doing all right. Watching those sleepy markets right now, but I'm sure it's going to change towards the end of the week. So we're always ready for what's to come.
Yeah, exactly. I'm getting to the point I might have to order some Lego to do at my desk while I'm sitting here waiting for something to happen. But yeah, something will happen eventually. We know that for sure. Right, well, let's talk about what has happened before we talk about what may happen. Over at the Bank of Japan, the BOJ is apparently going to discuss the rapid slide in the yen at this week's policy meeting. According to the Nikkei, these days it wouldn't be a BOJ meeting without getting some sources drops in the days leading up to it. The Nikkei piece saying that many at the central bank believe that the weak yen is not currently adding to inflation. That's a situation that a lot of other central banks are starting to circle around in terms of FX levels. One of the senior ruling party members or executives in Japan says there is no broad consensus right now that if the yen slides further towards 160 or 170 to the dollar, that may be deemed excessive and could prompt policymakers to consider some action. Bit of a strange comment, putting numbers on it like that. Some aspects can give it a green light to keep going. If I don't think that any action will come until 160 or 170, but there you go. That's politicians for you. Over in sticking with the government, the latest economic assessment was largely unchanged. They see a gradual recovery despite some sluggishness. A bit of data out from Japan, PPI numbers, or services price index there, coming in at 2.3% versus 2.1 previously. So a little bit hotter there. Prior was revised up as well to 2.2%. So that's some good news on the Japanese front for inflation. Kay, what are we doing at this 155 level? Are we going to break it before the BOJ, or we're going to break it after?
Well, we're too close not to. And it's not your 152. It's not the kind of rejections that we saw just ahead of 152. So that makes me think that it's not as big. I can imagine some Japanese interests are up at various levels, exporter offers, likely slowing the process, giving liquidity to those who still need to buy dollars. The rest of the dollar perhaps doing a little less good right now, keeping it from breaking, but it's not looking as if it's such a huge level as the 152 may have been with all those big barriers and things. Seeing a lot of protection that doesn't feel like it. So I guess we are barring surprise negative US data. We may have a look through it, and then if you look at yesterday, albeit no dramas in the US data, but a bit weaker than expectations and the prior numbers, it still had a 30 pip effect, and then we're already back to where we were. So yeah, I think it's going to trade above. Whether it stays above into Friday is a different subject. So yeah, people still talk a lot about that 156, the famous 10 big figure move Kanda called during a month to be excessive, but I don't know. It's all waiting for Friday, and but I still maintain Friday could be a really hot day if nothing happens. Nothing happens before. We do have US data before. We've seen that Japanese data are rarely moving the needle for the yen. So yeah, I'm on the outlook for what's to happen on Friday. I may actually, if we get a spike through 155 and a little bit of an acceleration, I've already got to put in place, but then I'm still a bit long small dollars elsewhere, and I may actually just give a little bit of a tactical sale in dollar yen if we creep or fly anywhere closer to that 156 ahead of Friday.
Yeah, I mean, as we creep closer to Friday, you know, thoughts keep going through your head and whatnot. When I look at it, I see very low reasons or little reasons why yen will strengthen unless they pull a rabbit out and you know, pull a hike out. Even forecast going high, it just seems that in any which way they turn, doesn't seem like yen will strengthen at all or significantly.
No.
So it still favours that whatever they do, at some point we're going to go up. And if the market's waiting for the BOJ to get over that hump, then it's a formality. Like you say, we go through 155. But then does that, you know, increase the intervention risk even more? I mean, UADA must know that if their forecasts are not going to, you know, CPI forecasts are not going to significantly go higher, if they're unchanged or maybe even come down a pip, that's negative. If they don't indicate strongly about the next rate hikes, that's going to be taken negatively. Them and the MOF must know that if they don't do anything that sends yen pairs lower, it's going to go higher and it's going to have another crack. So are they sitting above, or are they going to sit above and knock it on the head this time?
Yeah, and the thing is as well, if the Bank of Japan doesn't move on Friday, which is still the base case that they don't move, they may change something to the statements, the rhetorics. We already heard from Ueda that he said that weaker yen may influence inflation, thus may influence monetary policy. But if they don't do anything on Friday, I mean, look at the differentials in the yields. I mean, it's Japanese investors are still investing outside because they have very little choice. The 10-year JGB yield, which is the one that is the most watched, is still not at 1%. We do know that they also promised, even though they will buy less JGBs this fiscal year, that they would step in if the market goes a little bit bananas. That means clearly to the top side of the yields, because they don't want the bond market to derail in Japan, because the government need to fund trillions of yen. It's all I think it's still a very big trap for the MOF. So makes me think that even though I think Friday could be very hot, and I think the MOF is the MOF is praying for a little bit of a weaker US data on the US data front to have more impact if they need to intervene. But in current context, imagine they intervene and they put it down at 150. I think the whole world and all hairdressers and taxi drivers even will wait to buy dollar yen if they put it down to 150. They will not be able to keep it lower. Everything, all else equal, unless we get that very big surprise that UADA hikes, and you know, there's base cases, there's things that we can completely rule out, and I would completely rule it out in because of the fact that he said they would go slow. The inflation data are actually coming down a little bit, but they are well below inflation on the interest rates. Look across the rest of let's only look at the majors, right? The US is at 5.25, 5.5, where inflation is running around 3, let's say 3%, to make it easy. Some metrics are above, some below. The Eurozone is about the same. They're at 4 something, and where the inflation is slowly, albeit sticky, coming down. England may be a little bit different, but headline inflation is also showing signs to come a little bit lower. All their interest rates are above, or at least equal to, where inflation is running. Japan is 2% below their where their inflation is running. Okay, so there is this chance that in my mind, which says that the percentage of them, the risk of them hiking is not zero this time. And that is what I really want to bear in mind. And if they do hike, then I think the market is going to react to it probably for a bit longer than just having this 50 or 100 pips drop on the announcement and then take massively the other way. Now it all depends about the statement as well. But if they because if they just officialize 10 BPs or so, the market is still going to go like have a shock reaction, algo reaction, and then say like, well, 10 BPs versus 4.5, 460 in the States on the 10s and or 5% on the 2-year, for instance. I mean, it's still going to be only a drop in the ocean, right?
Yeah, exactly. And it should also be noted that whenever they've come in and intervened and acted, they've always had backup with either the Fed changing its tone or the data turning. The last 2 times they intervened, we had that big obviously turn there. That was when the Fed also started turning, getting towards the end of hikes and whatnot, and got a little couple of data wobbles. Same thing here. So they've had the US coming in to the rescue around about when they've intervened, and maybe that will happen again, as you say, on Friday with this PCE data. Might give them a bit of respite. But anyway, as far as hairdressers front running a 150 move, I know mine will be, because he's not made money out of me for the last 20 years, so he needs to get his income some other way. Right, sticking with inflation, Australia as well, as you can see there, a swathe of green coming in. They're doing a bit like Canada with their inflation and try and have 80 different metrics to try and gauge it. Predominantly, most of them coming in below last month, so all lower, but what they've all done is beat expectations in the main. As you can see there across all the numbers, year on year CPI 3.6%, but down from 4.1%. Some of these are Q1 numbers coming in unchanged. This one a little bit higher, the monthly number, year on year weighted mean, blah blah blah. All of that is pretty much higher for longer data as far as the RBA is concerned, so not really anything for them to get their teeth stuck into. Inflation moving down, but coming in stickier as well. Riksbank Steden, speaking about inflation as well, says inflation has moved in the right direction. The latest outcome was significantly lower than our forecast. These guys are penciling May for a rate cut, and that inflation number would help that case. Also talking about interest rates elsewhere, say high interest rates abroad could also affect the krona, and so the krona definitely remains an inflation risk. Over to the good old Bank of England, and it's whack-a-mole with a doves and hawks. We had Ramsden coming out and being all hawkish. Since then, we've had Haskell coming out going the other way, and now we've had the chief economist Peel coming out as well the other way. It started off by saying a combination of little news and the passage of time have brought a bank rate cut somewhat closer. Though he says the time for cutting rates remains some way off. Said yesterday's PMI survey data supports his existing policy view, and says there's greater risk of easing policy too early than too late, and told us not to get excited that headline inflation will fall to or below target, saying he'd err on the side of caution for cutting the bank rate. He says there's no reason for the BOE to move rates in lockstep with either the Fed or ECB. The latest official data showing a big fall in employment should not be taken at face value. Now, after those comments, remember after the Ramsden comments, we went from fully pricing September to fully pricing August for a rate cut. Well, now we're back at September after those comments from him and Haskell, and we're pricing 49 pips of cuts by the December 19th meeting, so roughly 2 cuts for that. Obviously, the pound has reacted as you would expect. All those lows in the quid are now been reversed. Kay, we're getting all this all the time now, aren't we? One lot comes out one side, another lot comes out the other side. Market
Crazy.
moves both ways and then parks up in the middle.
I found it, well, I mean, crazy and hilarious at the same time. You get Bailey and Ramsden saying that that they are, if they can, they would have cut yesterday. Then you got the data showing something different. And then you got two other guys coming in and say like, well, hang on a little bit, we may not cut straight away. I mean, it's great. When you talk about Bank of England, I mean, really, it's a crazy lot, right? And yeah, the market, this reaction. So we had those an initial reaction on the back of this crawling back and taking back what their colleagues were saying, and then you had a little bit of an add-on there when the US numbers came out. I think it's a case of people having been short sterling too low on the back of Bailey and Ramsden. And then needing to scramble back those who sold a bit too low. I was pretty well. Not that I felt something coming, but yesterday we've been talking about those levels. I mean, starting to hold, and despite good data, euro dollar don't break, not breaking straight away. Sterling did its 150 pips on the back of Bailey and Ramsden, and it's all like, and we know how the market trades as weather vanes. So I really did reduce sterling short to the max, even flat. So lucky enough, but I think we are still in the same scenario. Can go up. It's like one step up, one step down, probably. It's interesting that we capped around that 124. 57 here, got a bit of a trend line there, got a few fips around there as well. It technically is behaving pretty all right, I must say, the sterling right now. I think where we have to screw back beat our expectations. Well, that's the feeling that I have, at least, and that's why I sold my euro sterling out as well as euro sterling. We had the runaway. But it was basically just based on what Bailey and Ramsden were saying, right? So if you take pure the Bank of England bots, they are like 2-2 and ball back in the middle. So I think euro sterling, perhaps the expectations have to be just scaled back a little bit on what's going on there, and we are likely what I think just back in ranges there right now, albeit a range which is likely 50 or so pips above where we were before. If we were trading 85 and a quarter, 85 3/4 before roughly, or 2080, we may now be trading 85 80, 86 30, and then that's so roughly where I see it. If you look at if you quickly look at what the options are saying, the euro sterling options are still vol is still below 4%. So the even if it's like a tad higher than what it was, the option market is still very relaxed in euro sterling as well. So basically that's it. Respect the levels on that cable, and now we are back to watching US data, I guess, into the end of the week to know what's really going to happen.
Yeah, exactly, mate. And I did the same. I screwed back some of my euro sterling longs last night, 90s, in the 93, I think I did. Just to take a bit off the table. I'm still happy to play the range down to 95s. And one of the reasons I'm still happy to stay in this trade long euro sterling is that, when the Bank of England do start cutting, there may be a bit of a gap at the moment. There may be the higher for longer risk at the moment, but when they do, they're going to have to come down more than the ECB will have to come down. And then once rates get to roughly the same level, then your trade is matching up who's a bigger economy, and that favours Europe over the UK all day long. 27, 28 countries versus the rest,
exactly
19 countries versus one. So that weight differential, as far as my strategy is concerned, would favour the euro just on that basis. But lots of water to go under the bridge before that happens, and we'll see what it does. But other than that, I'm just going to ping pong the range off the long side. Right, ECB, and we have one semi-hawkish holdout left at the bank. ECB's Nagel says he still needs to be convinced that inflation is heading back towards target before rates can be cut. Wants to see more data before committing to a June cut. Says he sees momentum picking up in the German manufacturing sector. Back on cuts, says a June rate cut is not necessarily followed by a series of rate cuts. Is not fully convinced that inflation will actually return to target in a timely and sustained manner. That's the German in him coming out strongly there. When we got Hawke Holtzman even lining up and happy for cuts, how long before all the doves are waiting for Nagel in the bike shed ECB HQ for the next meeting to give him a good shoeing? Because he seems to be the last holdout, mate.
Managing expectations, I think.
Pitching into a strong wind at
Germany
the moment.
Is still, but Germany has still a very loud voice, right? In Europe in general. I think he's more managing expectations. The one that I find who's gone extremely quiet is the Dutch guy. Not he's flipped around. He said, but he's only been speaking like once somewhere, and haven't heard from him since, because he used to be with Nagel and Holtzman and perhaps one or two more from the Balkan side. He used to be very hawkish as well, but he's gone extremely silent. Perhaps Lagarde looked him up somewhere. Yeah, but I think Nagel is more managing expectations right now. He's not. I don't think he's completely cut averse, but he wants to keep everybody with their feet on the ground. If you'd let Villeroy and Centennial rule the game, they would cut every meeting from June, right? And I think he wants to counterbalance that, and it's sort of done on purpose. That's what I think, because he did say before now, trying to fight back against or taking the cautious approach. He did say once that he agreed with it, and I reckon that he saw the market reaction or people reacting, not specifically euro crosses or whatever straight away, although it had weighed on the euro somewhere because they all turned. But I think now he's back, and that's managing expectations rather than much else, to be honest.
Yeah, but if any other Eurozone country faced the economic problems Germany are facing right now, they'd be screaming for cuts. And it just shows you that, Germany always has their thing is always inflation. They're always shit scared of inflation rallying higher or not being where it should be.
Because
even at the behest of the economy.
He's waiting for the water level of the Rhine to rise again to change his tack now.
Well, good luck with that one. There's a heat wave coming, apparently. Heat wave going on in Spain.
Yeah, exactly. I mean, that's let's face it. Being one of the manufacturing engines of Europe, that's not looking extremely good for Germany coming summer either.
Yeah, so that's going to be a problem. But it's going to be. Someone's saying it's going to be 26 degrees in the next week or so. So time to get the old string vest out, I think. Right, anyway, let's crack on. Yesterday, we've got a bit of data out. It's not on the calendars as usual. Fed services activity coming in less crap than it did last month, at minus 12.4 versus minus 18.3 previously. We also got the S&P Global manufacturing services PMIs, and both looking a little bit smelly. Manufacturing was expected to rise a pip, actually went backwards into contraction, so quite a significant drop there. Services as well, we'd seen largely decent service numbers across the globe in the other PMIs, but that went backwards as well. Was expected to rise, went down instead. So this one's not as big as obviously the ISMs, but it still gave the dollar a little bit of a kick in the pants. Sent euro up over 107, managed to get a 28-30 pip drop in dollar yen. Not overly bad, as I say, we'll have to wait for the ISMs to get some real data. New home sales, on the other hand, was a bit of an improvement, beat expectations. So seemingly those last numbers existing and starts and permits not shown through in sales, at least, the slowdown in those prior numbers. House prices, the median house price was 431k. I'm just going to round it up, which was down 1.9% from prices a year ago, but was up from 406,000 as a median last month in Feb. So a jump in prices there. And that's it. That's all I got, folks. Kay, anything else?
No, it's been extremely quiet, right?
Yeah.
Some of their, I don't know, just in between, just something that rolled off the press a few minutes ago is China telling their brokers to limit exposure to snowball derivatives. It's just a way of trying to keep risk in check. It's those kind of derivatives are what we can compare to power jewels, as for people familiar with what Japanese corporates used to do in the past, and some playing as well. That means that you get some return for as long as a certain asset remains inside a certain range, but once it blows, you lose every protection, and you basically can be looking at very hefty losses. So they want to rein that in now, and it didn't really have too much of an effect on the Chinese yuan, but it is this one little more step from by China to get perhaps a firmer grip back on things. It's a very small step, but it's one of those steps that we need to just put in the list of, oh, tick, 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 tick. They are doing this. On the other hand, I do also think that a lot what's going to go happening in the, well, let's say dollar China is going to depend on the dollar, but also what's happening in the commodity sphere and actually gold. If they don't come in and continue to buy gold, I think it may be that most of it is done, and then I would suspect that perhaps dollar China is maybe going for a walk higher again. But let's see. In the meantime, they are trying to get a control over everything.
Yeah, and the exposure to that is some $46 billion according to UBS. So it's not
small.
It's not small, but it's not a crisis amount, shall we say. It's not going to collapse the financial system in China if it went pop. Well, even less so now they're shutting it down. But yeah, not a small amount, but not a big amount to cause real problems, particularly to China. Can I just check? I don't know if it's me. I heard you just breaking up a little bit now and again, Kate.
No, are
you hearing that from me, or?
I hear you perfectly.
Yes, I don't know if you've got a little bit of wobbles on your internet or something. It's not significant, just every so often. I just wanted to check in case it was me that was having the issue. But,
no, it could be my side. I think apparently Big Ben has stopped ticking around 9 a.m. Must be impacting my internet.
Yeah, you've got too many games open while you're waiting for something to happen. That's what it is. Just shut some of them games down, mate. Right, let's have a butchers around what's going on. Euro sterling, as mentioned, failure up at the zone, back down under 86. There's times when you get moves, especially in pairs like this, when it makes a move, right, it's made a move, it's got to do more. It hasn't done more at the moment. So are we going to go back into the box here and just stick to this boring range? If we get back below this 80s, 70s area, then we're going to be messing around in this area again once more. So it's becoming wise. We're saying it so many months now. If you get moves in pairs that haven't walked anywhere for a while, you've got to take your profit off the table just in case you get a reversal. Aussie dollars, another one. Big old zone here, been on my chart for yonks and yonks. CPI moves, everything else, up we go to the zone, nibble in it, and then pop, we come back down again. These levels, they stay on my chart. It's not that we necessarily trade them. You maybe buy or sell there, you can do, but it's when you're in a trade, you've always got to watch where your trouble areas are. It's no good buying 64s, 64.5 and saying, yeah, this is going to, I'm going to set a target of 68. If you can't get through these areas, you're not going to get your 68. So you've got to ask a question. What are you going to do with your trade if you're not going to get through here? And for the likes of me, I know Kay's the same, you take some profit, you take a bit off the table, and then you wait and see. Maybe it does move through. Okay, fine. You're not going to make as much. But if it does reverse all the way back down and you had a chance to take some money off, you haven't blown that chance and sitting here back down near your entry thinking, why didn't I take some money off the table? So and the other thing this thing shows is that these moves, they lack a bit of conviction. Yeah, it's a fairly strong move, you know, up from there on the back of a bit of data and whatnot. But, you know, it runs out of puff at one of these zones and then, you know, look at it for context. Yeah, it's a big zone short term, but, you know, it's nothing in the bigger trend. It's just a zone that's had a lot of traffic at it. So you've got to think, you know, market hasn't, yeah, it's going to move, but it hasn't got conviction to really make a move. You know, a proper move is getting up to 66, and then you start thinking about what's next. And we're getting a lot of that at the moment in a lot of pairs. You know, I mentioned euro dollar. A lot of people in our chat room absolutely lined up to smack this 107.20s, you know, and a few people started getting in about on this break here. And that's the right thing to do. You know, we had a little move above. Can it hold it? Tried holding it, then it falls out of bed, and that's enough. And down we come again. And now we look at this 106, 70s, 80s area back under there, and we're back in all that noise again. And we're still maintaining 106, 107 as a bit of a range. Cable probably might have to, we'll see what happens at 125, but we might have to extend this range. We were looking at 123, 124. Short term might be now be 123, 125 as a wider edge. Obviously, we've got some resistance coming up, 124, 80, 85, that sort of area, just back of those two highs. But yeah, again, we're back in the noise. We've had a move one way, we've had a reversal, and now we're in what next mode? You know, where are we going to go? Back down to 123, maybe up to 125. Who knows? We're all watching data. We're all waiting for the next headline, next central bank comment. So again, if you've been long in this one, you've got to be worried about the fact that we can't break and hold above 124.5, because that at the moment has been a bit of a pivot area. We've shown time and time again. A historical level goes back much further than that when we've had a lot of action there. As you can see, 124.50 all the way through there. That's why it's a level. That's why it stays on the chart. Something usually happens around there when we get there. As for some of the other bits and bobs, dollar CAD, that's still holding. I probably could have made my money this week trading this one off that bloody 135 or 136.5. 55s it's got down to. Keep bouncing. So it's showing up again. Again, just one of these old levels that you have on your charts and you just keep an eye on. Bounces, though, still looking pretty weak. We're not even getting back to 137. So it's not out the woods just yet. You know, same old pattern, lower lows, lower highs. So if it fails below 107, then maybe that's the time we get a move down through that 136.50 and off it goes again. However, if we hit 137 up here, 136.90, come down, hold 136.50 again, then maybe we get a bit more of a solid bottom and we get a bit of reversal. But again, this could all happen over a data point or some central bank head or whatever coming out. Fundamentally, there's no real reason for this to move any which way from here. Stocks, I'll just have a look at stocks and I'll bang it over to Cayman. S&P had a little carve up that got through this 40-50 area. We had a bit of resistance there Monday, carved through it yesterday. Now we're back above. This is likely to become support now. And see if that holds, then maybe we're pushing up a bit further. And then we're going to be having a look at 5,100. Next zone isn't until we get to the high 51s, even though we've got some intermediate levels around here. But this is the main pivot area at the moment. Hold that, then we're going to push higher. Back below, maybe we go on to challenge the lows once more. Cayman, Give me some inspiration, please.
Huh? Today? That's a good question. No, but we have seen a few levels come up, and allow me to show a slightly different picture than yours in the cable, because this is one that I showed yesterday as well, and I was already talking about this level in on F.A.C.E as well. So we went back above this 123.65.70 after hitting 123, and I said like, well, perhaps we can grind up into this or move up into this bit of resistance. I do have resistance at 124, call it 55.70, and that's exactly where we stopped. So this is an area of interest to me, especially with more US data coming up for the in the latter part of this week. So that is a bit of a zone that I'm going to quite closely monitor. And then, of course, above there, if it would go, we're talking about the 125, 125.20, and then this zone here. If it would fly higher, this is going to be a biggie, in my opinion, 125.5 all, up to 125.70. But first things first, and ranges being what they are still right now, I think it's good enough to have a bit of a look here at what's happening in this 55.70 zone, which is the high yesterday, little overshoot of this small trend line, and then we came back down. So that's an interesting one. And speaking about sterling, with Bank of Japan close to now to coming up, sterling yen. I was thinking that there would have been resistance between this 191.60 and then 192 the figure, but then Pill and what's the other one? I forgot his name. Haskell turned around the sterling, turned around the cable as well, and we are back towards the top end of this triangle. But this is one, and of course we need a bit of a little bit of I'm not going to say deep pockets, and it's against what funding tells you to do, right? But if we would expect something about interventions or so, we are in this quite interesting zone on the sterling yen here, anywhere between 192.60. We went up actually last night and overnight up close to this 193 again. You see this zone is bit of a zone of interest, I think, and if you want to play an intervention or a possible surprise by the Bank of Japan and thinking that sterling is perhaps finding a bit of resistance in the mid 124s in the cable, this may be perhaps a bit of a candidate to try it. If we get back above 193.5, skies will open again. I've got really nothing up to 196, so above 193.5, it's wrong and abandoned ship. Okay. But this one could be an interesting one to trade for a couple of 100 points if we see a reversal of this one. Just one that I'm keeping an eye on. Yeah, the Aussie, you showed it already. 65, 25, 45. It's becoming a real magnet. This one. I'm not going to repeat endlessly what we've been saying. 59.5 Kiwi. Have a look. We had a bit of a spike up there. We're trading around 35 right now, but it looks to show up again, this 59.5 again. So that's your first little level to the top side. 59 obviously to the downside. All right. Swiss, okay, because we are back to more interesting levels. We are back to the 61.8 in the Euro Swiss of the 2023 dump. We've had a bit of activity around it, but I would say, like, respect the level. It is perhaps worth, if one's long Euro Swiss like I am. I've taken a little lick off here. I'm still looking in the broader picture for this to move higher over time, but ECB may call a halt to this, but it's how shall I say? It is positive that despite a big majority of ECB bots now calling for June to be a rate cut, that the Swiss, Euro Swiss, and in particular did not react to it. That means that the Swiss is still weak enough to me to continue to weaken right now. We are also back to more. No, that's the sterling Swiss. Sorry, I was planning to show the dollar Swiss. Yeah, the dollar Swiss, we are back into this zone as well, 91.40 up to 91 and a half. We need, as I've been saying before, when we were in this zone and close to this zone, we need a close above to move up into the 92s for a starter. But then if you look, if you compare it to the 2023 move in Euro Swiss, and for as long as the dollar data don't fall out of bed, but I'm not sure. We have to wait for that. But for as long as the dollar data don't completely fall out of bed, I think there is still more weakness to come in the medium term. That is in the next month and a half or so, and then we will see. Now, that is all with ifs, because as Ryan and myself already endlessly repeated, we are data dependent, and to me, the next jobs report in the US is always going to be the next big one that we need to watch. If that confirms that it's still defying the laws of gravity, this dollar Swiss is likely going to continue to move higher, and I would say like at least 94 and a half or so. Why not even higher? But let's see for that. Time will tell. In the meantime, barring this Middle East blip, we see supports holding up still pretty well. So that is still something that is supportive to me. Euro Aussie, that's the other side. I know Magix is short in our room and very well held, by the way. But yeah, yesterday I didn't have the nerves to really enter a short position, but it looks to me that this is going to find resistance every time we bang up in the 165s, 165 and a half. There is resistance coming up. I would not rule it out that it does it again. Of course, we're coming into support. Low 164s, 163, 50, 65 is going to be support. Perhaps we're just inside a range, but I'd rather be a rally seller on this one right now. Ali, can it go to 91.55? It's 15 points away, dollar Swiss, right? I mean, we moved up to what, 45, 46 or so? Of course, it can go there. If Euro Swiss pierces this 70, 75, it's probably going to be there relatively quickly. But just know that we have US data, and the data are what is directing what we are doing here in all those dollar pairs, right? Gold trying to get above this 2026, trying to get above this 2026 again, failing in the 30s. If we get we're data dependent, but I would rather say that there is a better possibility to go and visit 22 and a half than there is to revisit the highs. This is just my feeling right now. This is how I feel the thing is, because we're getting less of those big spikes. Of course, on the next week US data, it can spike again. But all things equal, it looks a little bit like running out of puff to me, and we may see a bit of a move back into the 21 and a halves. That's what I think. Same on the silver, bounces, yeah, but can we get back to those highs? I'm gonna say I'm a little bit in doubt right now. But I'm patiently waiting to reload what I've sold up in those in the 29s the other day. Low 26s for a starter, mid 25s, another little leg, and then see if anything thing goes back down. But over here, by the time we are over here, I will probably be loaded up full truck again if we see this these levels here right now. And you know what? That is about it. I was going to show something else, but I forgot what it was, to be honest. Let me see if I can find it back. No, I don't have it. I don't see it anymore, what I was trying to show. Yeah, 155.10 could be, if it's a barrier hunt, it could be just 155.10 and then come back a little bit before. No, I'm going to leave it there.
Thanks, mate.
Yeah, back over to you.
Yeah.
Yeah, the yield differentials are not really moving much, Ali, right now. Bit of a ping pong, really.
Yeah, exactly. Keep an eye on them 2s and 10s, 5% or 5.1% and 4.7% 2s and 10s. That's your kick up, probably for another leg high in the buck. Michael was just asking about how you trade stagflation in the US. It's a bit of a difficult one to try and put it through really quickly. I don't foresee stagflation necessarily. That would require, real higher inflation and the economy really dumping. I think stagnation's more likely the case, which, by and large is what we've been seeing in the US, not so much in the US, but in the Eurozone and UK and whatnot, where, growth has been anemic at best and looks to continue to be so for this year. So it's going to be trading similar to what we're trading now. If inflation does pick up and it does move to a more stagflationary scenario, then yeah, you're going to get all the world is ending cranks coming out. Inflation being high, rates being high. How is the US going to service its debts and whatever? Is that going to put pressure on? All that sort of stuff will come flying out, and the market, if it believes it, will take a down view to it, and you'll probably see yields shooting higher and the dollar getting dumped. But where money goes after that is anyone's guess. It's not going to go to a weak-looking Eurozone or anywhere like that. So it'll be a messy trade whichever way it goes, but I don't really see that happening. Stagnation, more's the risk, I think, for that. Anything you want to add to that, Kay?
No, just that stagflation is a bad thing. It's really bad. Whether it is for assets or a currency, it's really bad. That's where you see.
If markets,
huh?
I was going to say, if it is a proper full-on stagflation situation, monetary policy can do absolutely nothing for it. It's one of those situations you've just got to let it go and let it play itself out, however that may be.
Right. It doesn't look to be the scenario right now, and
No.
you know what? It doesn't really look like to be a scenario that we can say or call with a relatively high percentage in any of the countries. Yes, we had this weak European and UK zone growth together with high inflation, which could have been well, which is somewhere the definition of stagflation. But then we have seen a different approach in the market, saying like, well, we need to see growth below zero for more than just what we've seen now. And also the reason why it hasn't been really traded as such, or perhaps in parts it has, but it hasn't been traded as such. It's because of the pandemic, because the pandemic has shifted the ideas about how during that period of accelerated cycles, we had a really accelerated cycle since the pandemic hit. So it hasn't been really brought forward as a more a stagflation play in the countries, because it was a health problem, and the whole world economy was affected by it. The whole supply chain was affected by it, and but yeah, in general, is it possible? It is possible. I mean, if all of a sudden those and again, I mean, I know that people talk about inflation sticky, central banks are trapped, but I'm going to repeat. I think if the job market declines, Fed cuts, whatever happens, and whatever else happens in the inflation environment. But if they start to see a much weaker. I mean, it's not like a miss or coming out at 100K NFP when we expect 200. No, real worsening of the job market. That's going. Then we are going to start to talk about risk scenarios if inflation stays higher.
If you want to put a rough pencil drawing over it, Michael, if you're smelling it, you know, if you start seeing CPI over 5%, and we start seeing the economy posting negative numbers, then you're on your way. But yeah, I don't think we're there right now. Anyway, hope that's answered your question, mate. Obviously, you're in the chat room, so you can badger us about that. We've got nothing else to talk about, so go ahead. We'll call that a day for today. Thank you for coming to the Flow Show. As always, thank you, Mr. Keyman, for all your valued insight. Durable goods later, and Canadian retail sales, the stuff on the calendar. Other than that, have a great day, and we'll see you all tomorrow.